Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I'm going to respond to a question that was asked and answered by, I guess, a lot of people on Twitter, and I'll give you my opinions around it. I guess I must think a little bit differently than perhaps other people, but I will share my thoughts, share my financial opinions on here, and you guys can obviously put in the comment section whatever you'd like. And I do deploy some of this with the way that I view the markets. So it's my paradigm, it's my strategy, it's my thesis, it's everything kind of put together. And I'll give you my opinions here, and hopefully you guys can learn something from it. So here's the question here. So the question is, seriously, I see so many fall in love with a thesis, they are unable to let go of a trade, even if losing money. So that being said, which of the following two choices is most acceptable according to you? And they said 72.5% said wrong thesis, making money. And then 27.5 is right thesis, losing money. Now, I voted for the right thesis and losing money. And I think it's maybe perhaps a viewpoint that people have. So when I looked at this, there's nothing here about chart reading. There's nothing here about technical analysis or anything about that. They just said in this particular question, it says that you have two choices below: wrong thesis, making money; right thesis, and losing money. And it's not tied to any particular sector. Now, here's the thing that you can have. You can have the right thesis and have the wrong timing. No big deal. If you wait long enough, you make money. So what a lot of people get wrong is they have the right thesis. Let's say there's a commodity bull market coming and you bought at the wrong time and you went into volatility. And that volatility you can be down 30, 40%. But if you take a longer time frame, well, then you make tons of money because the thesis is right. Now, if you've got the wrong thesis and you make money, what that does is it basically gives you feedback to that person and saying you are right, but you've got the wrong thesis. In order to make lots of money in the market, you have to have a process, a strategy that works, or a process that works. If you make money and you've got the wrong thesis and you think you're right, even though you are wrong, you will not be able to replicate that money. The process is broken and you got lucky. You got lucky. What does it mean by getting lucky? Now, you can have the right thesis and also make money and also get lucky. There's a part of luck. So a strategy or a thesis may depend on probabilities. And if someone said, you've got an asymmetric bet that's ahead of you, you can make 100 times your money and your downside risk is 20%. And someone says, all right, I'm going to take it. I'm going to take it because it's so lopsided. And let's say you lose 20% in that outcome. Does it mean you're wrong? Yes, it means you're wrong that you lost money, but you should be taking that bet. And maybe the bet didn't pan out that way. It could have been natural gas coming into a very tight market and we had warm weather. So the person who said, and I'm just going to make this up, interest rates are the reason why natural gas prices fell. I don't think that's right. That's their thesis. They had a wrong thesis, but they made money and got lucky. If the weather were very cold, what we would see is a much shorter drawdown. Maybe we go sideways and then we take off again in the future. That's having the right thesis and making money. And you know what? If you take the time frame long enough, you may still be right in your thesis. You would have been wrong in the short term, and you can still be right in a longer time frame. Having the right thesis and having it actually be right is everything. Why is that the case? Technical analysis is the ability to see how humans are behaving against each other. And that does have merit, and that does have an ability to make money because you can see how people are positioning, you can see money flows, you can see everything in the market based off of how humans are positioning. But guess what? That's not everything. A thesis could be developed and a strategy developed around other things outside of technical analysis where you can be very successful. You can have earlier entry points and still be right, depending on the strategies that you basically develop and deploy to the portfolio. So, in my opinion, the most successful thing that you can do is figure out why the patterns are forming under certain market conditions. That is what literally the root cause is. So when you look at this, when someone's looking at just technical analysis, what it tells you is how the humans in the herd is behaving, and they're throwing up certain patterns. Those patterns, if you don't know anything else, you're going to get scared out of it if you're trying to play the big move, which means you understand how the humans behave, but you have no understanding of why they're behaving that way. That is everything. So if you can change your investment paradigm to look at the leading indicators, technical analysis is not a leading indicator. It is a symptom of a market condition. Does that make sense? So let's say humans behave a certain way under an inflationary environment. Now, obviously, you can use technical analysis to verify and validate certain things, but you can have leaders and you can have laggards. So let's say a thesis is a demographic coming into home buying years. You look at certain other things like the yields, you look at inflation, and then what eventually comes on the back end could be other commodities. And you could maybe have a crescendo effect where certain things hit and it crescendos over. And it's like the first thing that comes is the demographic. Then home prices start going up. Then inflation comes. Then oil prices and inflation kind of go together. CPI data comes, and it goes on and on. Energy service companies come after that, and so on and so forth. Now, I have no problem buying a bottom if I see the front half starting to move and buying back half companies that respond a little bit later, where I'm buying literally the bottom. Now, you can have a bottoming pattern, and you could be tying this all together, but that gives you the confidence to do it. That's what makes you a better investor. You're looking at different patterns and validating the leading indicators against patterns that you've seen before in the markets. You're knowing why the humans are behaving that way. That's what gives you the confidence. Now, if all you're doing is just looking at the charts and you have no background and no understanding of the markets, you have no understanding of how the things are interconnected, you're not going to buy bottoms. You're just not. You're not going to extract the most value out of the market. You're going to be waiting. You're going to look at the lagging indicators. You're going to wait for downtrends to be broken and all this other stuff. And then you're going to buy when it's 200-300% off the bottom at least, which could be the difference between a 10-bagger and a 50-bagger. Big difference. And I know, and that's if you can hold on. Because if you don't know what's causing these humans to behave a certain way, you may not know that you need to still hold on. Because the market conditions, if they're still favorable, are basically guiding humans to behave a certain way. And that's where all the value is. The technical analysis is a way to validate, an unbiased way to validate what is going on in the markets. The market conditions and the way that ratios and all these things are moving together, and if you can tie it all together with a thesis, you are going to make a lot more money, in my opinion. And we've got people who've never even used technical analysis who are some of the richest people in the world. That's Warren Buffett, Peter Lynch, and all these other guys. And what they did is they held on to companies for a very long time and rode through all the volatility. They rode through all the different market conditions. I don't think, in my opinion, in this particular case, and I don't know, whenever they put these things up, I always seem to be in the minority, almost always. Last year, they said which asset would perform the best. I chose natural gas, and I think it was actually last year, the best performer of the ones that they had on there. But I would choose the right thesis. And the right thesis, even though you lost money, you still are right based off of the analysis. But that doesn't mean you lose money every single time. This is just one example, at least the way that I am reading it. Because it says, so that being said, which of the following two choices is most acceptable according to you? Just because you make money doesn't mean anything. It doesn't mean you can replicate it. So if you make money in one time, you're gonna, in order to be really good, you have to replicate it, which is a strategy or a process. Making money once, you got lucky. So what? Making money all the time, that means you know what you're doing. And it doesn't mean you'll make money every single time, but it means that your process is repeatable enough where you can make money and be sustainable and we'll say beat the market or at least match the market or whatever your measurement is. But I don't, I'll show a couple of other things. I said being wrong and making money is great once, but eventually you will give it all back. Right thesis and temporarily wrong can be mitigated with time. He says, what right on thesis that is not supported by charts is terrible. I don't know where he brought the charts into this. There's no charts up here. I didn't say anything about charts or anything. It says you're putting yourself in a corner just like a poker player that goes all in before the flop. It says, I like charts just like you, but the richest guys in the game played the game without technical analysis like Lynch, Buffett, and many more. Time in the market and letting it ride has to mean something. Also, they had the right thesis and didn't try timing the markets. So these guys, Lynch and Buffett, what they do is they find these ridiculously undervalued companies. They're generally boring stocks that don't get designed out of existence. They're like food companies, insurance companies, stuff like that, right? So they can buy a stock and in a short time frame, they've got the right thesis and they're losing money. And he's saying, oh, well, why would you put yourself into a corner? I just gave you the richest guys in the world and their strategies and their thesis. And a lot of the times in the short term, they're going to have the right thesis and are losing money. But they stick with it. They put more money, they pile in even more, and then they make a bunch of money because they have a long time frame. So what everyone does when they're new investors is they go into something, they go down, they get scared out, and they leave. Why? Because they have no thesis, they have no idea what they're doing, and they see the loss, they emotionally react, and then they sell out. They have no idea what they're doing. They have no strategy. Now, if you have the wrong thesis or you have no strategy at all, but you make money, is that a good strategy? No, it's horrible. It's a horrible strategy. If you've got the right thesis and you've got a good strategy, you will lose money sometimes. You will have volatility. You will go up and down. You will never time, I'll say you will not time the bottom within 5%, most likely, if you're going after these gigantic asymmetric bets in companies that move 5-10% a day. It is very hard to get within 5% of each bottom. Very hard. So you're going to have volatility. So you develop strategies around the volatility that work for you. There are times where I will pile into investments because the risk is so low, the asymmetric upside is so big, and my time frames are really long. As your time frame increases, your ability to buy a bottom and cost average in increases. So I'm talking about platinum and some of these other investments that I've been doing since 2019 and really loading in, where I think we're going to go up and I will outperform other metals with platinum. That's a strategy. I have a strategy to buy the entire bottom over some years, and when it starts to go and outperform other ones, then hopefully that works. I think the downside risk is pretty minimal, and I think the upside potential is massive. There are so many things in the market that can go right for platinum to go higher. South Africa supplying 75%, and their electricity issues, problems with the country. There's a whole bunch of things that can make this thing really go to the upside. Right thesis, losing money in the short term, no big deal. I'll buy more. Now, someone's going to say, oh, that's an opportunity loss. Shove it with the opportunity loss stuff, guys. Shove it. How many of you guys have multiple 5-baggers or 10-baggers or 20-baggers? All these guys, they say all this, but they don't have any evidence to support it. And that's where you have to take a longer time frame. That's why Buffett and Lynch and all these really good investors take long time frames. They cost average in on the bottom, and then they ride it for many years. That's how I developed my entire strategy and thesis myself. Now, I'm seeing, and there was other people on here that were commenting on something else. They were saying that natural gas, I'll pull it up here real quick. I'm going to get myself out of here. I was talking about natural gas, and I took a little bit bigger viewpoint, and I said, let's get off logarithmic here. I said natural gas technically has a Livermore cylinder. 1, 2, 3, 4, 5, 6, 7, and then we're probably going to do like a little hump or something and move on higher. And someone said, this is not a Livermore cylinder. That is definitely not a Livermore cylinder, Andy. You're completely wrong. And I'm like, all right. I mean, this is on Twitter. I can't say anything back, but I'm like, all right, guys, really? We've got Livermore cylinders in oil. We've got Livermore cylinders in uranium. We've got Livermore cylinders in aluminum and all these other different commodities. You really think that this isn't a Livermore cylinder? Now, a Livermore cylinder, when you accumulate this is right here. That's wave 1 with a wave 2 pullback in Elliott wave. This is where you see the accumulation cylinder. So you're telling me that this isn't an accumulation cylinder, even though we see it across all these different commodities. And it's wave 1 and wave 2 pullback. Now, wave 2 pullback, I think, was a little bit extended given the weather that we have over in Europe. And I've shown that on the channel here just yesterday. So when I look at this, and I'll just go to Chipotle, guys. Chipotle had a Livermore cylinder. All right, what does a Livermore cylinder look like? There's a Livermore cylinder on Chipotle. That and then look what happened afterwards. Boom, big time move, right? So there's the Livermore cylinder on Chipotle. And if I knew what that was, I'd be buying the crap out of it down at the bottom. Yes, I would. And these cylinders can be gigantic. So let me just copy this for the heck of it. There's the Livermore cylinder. I'll copy it. I'll bring it over to natural gas just to show you guys what it looks like. And of course, these guys, oh no, it's not a Livermore cylinder. Yeah, like they know much. Come on. And that's why, over time, I've really kind of migrated and do my own thing. Because I like doing my own thing sometimes. Oh man, I hate when it goes back to this. So 1 second, guys. Let me zoom out and shrink this thing because it's massive right now. And I want to show you guys kind of what this looks like. Man, I really got to shrink this thing down. Okay, there we go. So what I'm going to do is I'm just going to overlay it like that. Let's zoom back in and then I'll do another overlay of it. All right. So this is Chipotle and the accumulation cylinder that it had before it went ballistic. All right. So tell me that doesn't look the same. You guys in the comment section, if you don't think that looks the same, tell me it doesn't look the same. 1, 2, 3, 4, 5. It had a double top. We came on back. This guy hit. This guy's this. These two peaks are those. And then we come all the way back down, and we're going to have a little bit of a up and down motion here, and then we'll start to go higher probably again for natural gas. Natural gas, when looking at ratios, is ultra cheap. So what do you think I'm doing? I'm buying natural gas companies down at the bottom here. Pretty easy pick in my opinion. And guess what else happens? the natural gas companies have Livermore accumulation cylinders. So what does this mean? Someone could say, that's horrible. We don't see a clear bottom yet. I'm using a different pattern. I'm using a different strategy. I'm using a different technique. And you know what? Probably going to make more money than everyone else. Why? Because this is what I do. It's fractal and pattern recognition. If you've got the right market conditions and you've got across the entire sectors, they're all doing it. Yes, it's the pattern. That's my opinion. Now, could I be wrong? In the short term, sure. In the long term, I think these are pretty reliable and they'll work their way out. I don't think a recession can stop the entire pattern. It can in the short term. It can delay the move. It can do all sorts of stuff, which means we could go higher. And I don't know for a fact. I'm just telling you what could potentially happen. We could go higher. We get a crash. It goes down like this, and then we go back up again. Why? Because the imbalances in the market have not been solved from a structural basis. We do not have a supply glut. It's a demand event. So when everybody looks at this and they say, well, we could have a recession, they get all scared with these recessions. And it's like, guys, take a bigger picture view. A recession's a blip to the downside and then another big spike to the upside when the demand comes back. The supply isn't there. It's a supply-driven problem. You're talking about the demand. And yes, the demand and trying to time all this in the short term, with the supply all jacked up in some of these commodities that are coming up, I'm just going to ride through it. It gives me one less thing to worry about. Choose the great companies, and they're sitting in far better positions than they were back in today than they were in 2020. They're in far better positions, and now we've got fractals we can look at. Now we've got patterns that have been scribed out, and we know what's probably, with some sort of certainty, with a high probability, which ones could be the best performers in the future. You tie that with fundamental analysis of the companies, now you got something. Now you got something to invest on. So I'm seeing it in all the companies. Uranium companies have it. Natural gas companies have it. The Jesse Livermore accumulation cylinder, natural gas, oil, they all have it, guys. There's aluminum companies. There's all sorts of stuff that have it. And there's some pretty big patterns that are also, forming in fertilizers and all sorts of stuff. And I think it's kind of, you can't come out and say that one strategy works and only one strategy if there's more than one strategy that works. That is all I'm saying. I'm not anti-technical analysis, I'm not anti-whatever. I'm just saying there's other strategies that work. And I try to find what I think is the most successful strategy that works for me and my type of paradigm and how I look at things. I like fractal analysis. I like comparing patterns. And I like looking at the market conditions. The market conditions are what drive human behavior. Human behavior then scribes out these patterns. Once those patterns start to scribe out, you can kind of tell where you're at in the market. If you're early, late, wave 1, wave 2, wave 3, wave 4, wave 5. Jesse Livermore accumulation cylinder happens in wave 1. And then you get a pullback to wave 2. That's generally what I've seen. If you look at previous commodity bull markets and the waves that it kind of scribes out. But that's my opinion there. Hopefully you guys like it. If you guys need any help with anything, definitely subscribe to finding-value.com. You can look at the stuff that I've looked at. I've even put up fractals in some of my threads and posts on the website of what I think may potentially be some of the best investment opportunities in some of these areas. We talked about it during the Platinum question and answer sessions, and I also talk about it during our Wednesday midweek updates. So I think there's more than just one strategy that somebody can have. And there are certain times where you can have the right strategy and you still lose money. That doesn't mean that your strategy is bad. And that's what makes it difficult, is figuring out what strategy is the best and why it is the best. And it has to work for you, in particular, the strategy that you want to develop and deploy. All right, guys, that's all I've got for today. Thumb up for the content, guys, and subscribe to the channel, and we'll catch you guys next time. This is Finding Value.